What's up, guys? Welcome back to the channel. Today I want to talk about a mechanical trading setup. So we're looking at the NZD USD chart, the Kiwi, whatever you want to call it. This is one of my best performing pairs, and I really like to trade this. Recently, I've taken a few shorts in this pair, and I want to go over one in particular because it looked very good. And I want to explain why it looked good, the context, liquidity, the setup I took, the odds of winning, everything in there. So first of all, you guys that know me, I trade mechanical, which means no matter where my setup happens, I take it. But I also look at context, because if I didn't, I could just program my strategy and let it run in and of itself. But it is better if I add some discretion to it in terms of location and context, because I noticed that I make more returns that way. So if you're going to analyze, I took a short in this area. But before we are going to dive deep into that setup, I want to talk about the context, because what are we looking at? Why was this a better setup than normal? If we take a look here, we have a reaccumulation, a redistribution range, redistribution range, or a supply zone, as many of you might be calling it. And as you can see, we moved into that zone and we started ranging. This is a very clear distribution range. We got a swing high after an impulsive move, which is a buying climax. Then we got a strong retracement. We take out that high and collapse again back down. Then we take out that high and look at that rejection. This is just key. This is clear distribution. If I go to the H4, look at this. This is just a textbook example of distribution. Clear distribution range, clear fake out. Look at the rejection as soon as we break the high. Then we go to the downside. We break the lows, but we stay below there. Completely different price action than from what we've seen up here. So that's the context I'm talking about. And then, as we all know, if we get a distribution range, they like to retest and then go for the next leg down. Look at what we have here. This is the last bit of structure created. We get a rounded retest. We take out that recently important high. We take out that high as well. And then we again fall down. We break the low and again, we stay below the low. So every high that gets broken immediately gets rejected. But if we break key lows like we do here, we stay below it and we get a rounded retest. Same thing here. Same thing here. We break the low. We get around a retest. This one goes a bit higher, but again, we fall down. So in terms of context, we just fail to stay above new highs. Every time a new high is being made, we collapse down. And every time a new low is being made, we get acceptance. So that's very important to maybe implement in your own trading. If you see that on the chart, watch what happens. In this case, the clear distribution range gave me a short bias as soon as we broke out of it. Then I simply waited for my mechanical trading setup. So I got my mechanical trading setup exactly after the distribution range. So this is the distribution range. We're now on the hourly time frame, as you can see. And this is the retest of the range. And what lined up is that my mechanical trading setup happened at the retest of the distribution range. So that just gave me so much more confluence. Like, okay, we have a big daily bearish bias. And then as soon as we break out of structure on the daily, I get my setup to the downside. That's a confluence factor for me. So I spoke already about this on the 4-hour time frame, but we took out this decently high and this last swing high before the breakdown. We retest the redistribution range. As soon as we break this low and we get acceptance below it, I entered the short with a stop above the high of the fake out and of the retest. And then my target was simply at a 1-to-1. Now, you might be wondering, if you haven't been watching my channel a lot, why do you trade a 1-to-1? You need a 1-to-3, a 1-to-4, a 1-to-20. No, you don't. Reason being is that the odds of price moving down to my target before going to my stop was 70%. There was a 70% chance of price hitting my target before my stop. So even if I trade a 1-to-1, I win way more often than I lose. So I can take these type of trades. I can even take a 0.9R because I win way more often than I lose. If I go to my statistics about this particular setup, there we go. This is the back-tested spreadsheet of mine about this mechanical setup. And in terms of the data, there is almost a 67% chance of hitting target. However, because of the confluence factors and because I've been journaling that over and over and over again, I know the odds of winning were well above 70%. So this is just exactly how I trade. And this was a clear example. Of course, when things align, I risk more. I think one of the biggest issues that profitable traders have to go next level is that they don't risk more on the A+ setups. And there are many big firms that speak about this, such as S&B Capital. They have a YouTube channel. They are a firm in America. And if you are trading there and if you're consistent, but you're not sizing up on your A+ setups, you get called to the office basically, and you get some spanking because it's a sin. If everything lines up and you can back it up with statistics, you've journaled it, you have tested it, why not risk more? If the odds of winning are really that big, such as in this trade, you need to press your luck and you need to risk more. If I get a setup with a 60% win rate and a 1-to-1, or I get one like this with a 70+% chance of winning and a 1-to-1, why on earth would I be risking the same on that setup? It doesn't make sense. This is something to think about for you guys, and you can do this very mechanically. I also do this very mechanically. But one side note, only do this if you already have a working strategy. And if you can back this up with statistics, don't do this because you're like, oh yeah, it looks good. It does look good, but you don't know if the statistics back it up and if it's really a higher probability trade. You can draw a nice level like this one here and you'd be like, oh, there's so many touches. It looks so good. Look at all these touches. But does it mean that it's a high probability level? That's what you want to figure out for yourself. In your trading, if a setup looks good, it doesn't mean it has edge. And that's where a lot of people make mistakes. So that's something you might want to be working on as well. So yeah, that's basically it for today's video. So to recap this, we had a strong bearish bias. And as soon as we broke out of the distribution range, I got my setup basically in a redistribution range. We got acceptance below every key low, but we didn't get acceptance above key highs, which told me that there should be a bearish bias. As soon as we got acceptance below this low, I shorted with a 1-to-1 and a 70+% chance of winning. If you want to know more about my mechanical trading, comment down below. I teach my mechanical edge to my mentorships, to people that follow my mentorship. If that's something for you, also comment down below or just go to my website, which is also in the description down below. It's a game changer. I've had many good reviews. I only work with serious people, so don't apply if you think you can be profitable within 2 weeks. I don't like to work with you if you're someone like that. So yeah, that's it for today's video. See you next time, guys.